Hello and welcome to the Economic Angle. I am Bennett Legg. Today we will be exploring another school of economic thought, monetarism. This school of thought was popularized by the 1976 Nobel Prize winner in economic sciences and professor at the University of Chicago, Milton Friedman. This school of thought opposes Keynesianism, which is something we have already explored here on the Economic Angle. Before we can dive into monetarism, however, we must first discuss monetary policy, as without an understanding of monetary policy, monetarism would make no sense. So, what is monetary policy? Similar to fiscal policy, monetary policy is a tool used to reach ideal macroeconomic conditions and goals. It employs the management of the money supply and interest rates by a central bank. Monetary policy aims to keep prices stable through low and steady inflation. It also seeks to maximize employment and keep long-term interest rates moderate. Here in the United States, we don't have a traditional central bank. We had the Federal Reserve System, made up of multiple banks and a complex organizational structure. The Federal Reserve System, commonly referred to as simply the Fed, serves as America's central bank. You can't tell, but I put air quotes around central bank. I did that because it's actually made up of 12 Federal Reserve banks, each of which serve a distinct district, which is determined by geographical location. These banks provide services to commercial banks. For example, they distribute currency and process payments. It's important to note, however, that the Fed does not print currency, it simply distributes it. Within the Fed, there are two important groups to know about. First, the Board of Governors, which oversee the entire Federal Reserve System. The Board of Governors is made up of 7 members, each of whom were appointed by the President and confirmed by the Senate. Secondly, there is the Federal Open Market Committee, or more commonly referred to as the FOMC. They are the main policy-making body within the Federal Reserve System. This committee is made up of each member of the Board of Governors, as well as the President of the Federal Reserve Bank of New York, and 4 other Reserve Bank presidents who serve on a 1-year rotating basis. This group is considered to be in charge of monetary policy. Now that we know about the Fed, which is America's central bank in charge of monetary policy, it seems reasonable to ask the question, how does the Fed manage the money supply and interest rates to achieve ideal macroeconomic conditions? They do so through the employment of a few methods considered to be the tools of monetary policy. The first of these tools are open market operations. This is when the Fed controls the money supply by buying or selling government securities in the open market. This also influences the interest rates. When the Fed hopes to expand the economy, they employ expansionary policy by injecting money into the money supply, which lowers rates. When they withdraw money to raise rates, this is considered contractionary policy. The way this actually works is this. When the Fed buys government securities, they must buy them from somebody. They then give money to that somebody in exchange for those securities, and that somebody deposits that money in the bank. This increases the reserves banks have available to lend out, something we touched on in the previous video. This increase in the amount of reserves banks have available encourages lending and lowers rates. The opposite is true for when the Fed sells securities. The next tool of monetary policy is setting the discount rate. The discount rate is the interest rate banks pay to borrow directly from the central bank. Essentially, changing the discount rate makes borrowing cheaper or costlier, and doing this often signals a change in the central bank's stance on the economy. This also impacts other short-term rates. Essentially, it sets a floor for these other rates, such as the federal funds rate, which is the rate at which banks borrow from each other. Central banks use this tool to encourage or discourage spending and lending to both businesses and consumers. By lowering the discount rate, it becomes cheaper for banks to borrow, which leads to more money and investment, and an increase in the money supply and economic activity. The opposite is true when they raise the discount rate. The last tool of monetary policy is adjusting reserve requirements. We already know that America uses a fractional reserve banking system in which banks are only required to hold on to some of the money they have, and they lend out the rest. If the banks are only required to keep very little, they can lend out much more, which means a greater money supply. You can see how changing the required amount of reserves can be a huge monetary policy tool. When exactly is monetary policy used? Well, it's used to manage economic fluctuations. Its primary goals are maximizing employment and keeping prices stable. During a weak economy, or periods of inflation that is too low, the Fed will utilize expansionary monetary policy. During an overheated economy and periods of very high inflation, contractionary monetary policy is utilized. So far in the economic angle, we've explored economics through a first principles lens and also through the ideas of different economic schools of thought. We have focused so far on classical economics and Keynesian economics, so I think it's important to mention how subscribers to each school feel about monetary policy before our discussion of monetarism. Firstly, classical economists view monetary policy as largely ineffective for changing real economic activity in the long run. They would claim that, although it can change the money supply, the price level changes proportionally, leaving no effect on real wages or production employment. Since they also believe that markets will automatically self correct to full employment, they find monetary policy to be ineffective in fixing unemployment or boosting output. Keynesian economists, on the other hand, view monetary policy as a tool to manage aggregate demand, which is their main focus. They argue that it is a good tool to use alongside fiscal policy in order to stabilize the economy, particularly during downturns or recessionary periods. However, they believe that monetary policy creates opportunity for something called a liquidity trap, in which lowering the rates actually fails to stimulate lending. They also say that monetary policy is slow acting due to a lag between changing economic conditions and reactions from the Fed, as well as public reactions after such policy has been implemented. They view it as less effective during deep recessions as well. Monetarists, who are our focus for today, view controlling the money supply as the primary economy management tool. They argue that stable and predictable growth in the money supply controls inflation and stabilizes output, and they focus on long term price stability rather than attempting to fine tune short term economic conditions. Like I mentioned earlier, monetarism gained prominence through the work of Milton Friedman in the 1960s and 1970s. The school of thought was seen as a challenge to Keynesian economics during times of high inflation. The foundation of monetarism rests on an accounting identity. The fact that this is an identity means it is true by definition, similar to how the additive identity property in mathematics, which says that any number plus 0 is equal to that number, is true by definition, because when you add nothing to something, you are still left with that same something. The identity that monetarists focus on is known as the equation of exchange, which says that the money supply multiplied by the velocity of money, which is the average number of times a unit of currency changes hands in a given period of time, is equal to the price level times the amount of real output. The monetarists make the assumption that velocity and real output remain relatively constant, and therefore changes in the money supply have a direct and proportional effect on price level. This is what they call the quantity theory of money. Essentially, this theory says that changes in the money supply are the primary driver of nominal GDP, and that changes in money supply only cause inflation in the long run. Because of this belief, they advocate for stable, slow growth in the money supply to ensure prices remain relatively stable. Essentially, they argue that the central bank should use predictable monetary policy rather than attempting to fine tune the economy. In the short run, they believe that money supply changes temporarily affect output and employment, but ultimately lead to inflation. To combat that, they support long term neutrality, in which there is consistent money supply growth. They believe that market forces work best, and that government intervention, especially through the use of fiscal policy, can be less effective and even destabilizing. Now that we've had some experience thinking about the core tenets of another school of economic thought, let's take inventory of what we know now by comparing the three schools of thought we've explored so far. First, classical economics believes that the economy naturally moves towards full employment levels, and that prices and wages are quick to react to changing economic conditions, or in other words, they are flexible. They believe government should play a minimal role in the management of the economy, as they see government intervention as unnecessary and potentially even harmful. They focus on long-run equilibrium and believe that supply creates its own demand, an idea which I have introduced but not expanded deeply upon. That idea is known as Say's law. Keynesian economics believes that economies can get stuck below full employment during times of recession. They believe that this is caused by insufficient aggregate demand and inflexible wages and prices. They think the government should intervene using active fiscal policy through changing government spending and tax levels in order to boost demand during extended downturns. They focus on stabilizing the economy in the short term and managing demand-deficient employment. Monetarists believe that the money supply is the primary driver of inflation and economic activity, but that markets are an inherently stable system. They think that the only role of government intervention should be within the central bank, and that they should aim for steady money supply growth. They find fiscal policy to be ineffective and focus on controlling inflation by rules-based monetary policy, which manages the money supply in a consistent manner. To summarize, classical economics believe that governments should keep their hands off the economy and that markets are naturally self-correcting. Keynesians advocate for active fiscal policy intervention to stimulate change in aggregate demand, and monetarists support rules-based monetary policy and find fiscal policy to be ineffective. Well, that's all for today. Thank you for listening to The Economic Angle. My name is Bennett Legg, and I will see you next time.